Thank you. Good morning, everybody. And some of you were here yesterday, so thank you for joining. Today, my presentation is very much focused on financial stability, global financial stability. So it's a very different theme or issues that I described yesterday. This theme, particularly the issue that I'd like to talk about is global financial stability, particularly global systemically important financial institutions. It is often called too big to fail, or financial institutions too big to fail. And now our political leaders, like our Prime Minister, Japanese Prime Minister, or all G20 head of state, one of the main concerns of them is this financial stability, and specifically how to manage or control this institution so-called too big to fail, or globally systemically important financial institutions. So I hope that after my presentation you understand in this world there's some group of people who try to address this issue behind the scene. In other words, to make this world stable and safer. My presentation yesterday, I was advised I spoke too much, so today I try to speak shorter, maybe 40 minutes or so, and I appreciate your comments, questions, so that we have more sort of interaction rather than one-side speech. My presentation will compose of 5 parts. And I try to answer 3 questions. First, what are G-SIFIs, global systemically important financial institutions? What are they? And second is why are G-SIFIs important? And this is the part 1, sort of introduction. And then second, third, fourth, and fifth point is rather how we should deal with this institution, policy measures. So let's start from the first part. What are the G-SIFIs? What are G-SIFIs? So G-SIFIs is the institution, as I said, is too big to fail. Financial institutions, so-called too big to fail, or too complex to fail, or too interlinked to fail in a global scale. And if that companies or financial institutions fail, that could create significant negative impact on the global economy. We did not know that this existence, but after Lehman Brothers failure in September 2008, what happened in that world after Lehman's shock was banks did not trust each other, so banks stopped lending each other, and banks stopped providing credit to the economy. And you might know that banks played a critical role in our economy to provide funding or credit to the world. And because of Lehman's failure, banks or banking system in a global scale did not play its critical role. And after Lehman Brothers failure, as you might have remembered, there's a continuous economic downturn for more than 1 year, and it was a huge problem, economic problem, not only United States, Europe, but around the world, including Japan. So what happened after Lehman's shock is naturally financial system was very fragile, and there are plenty of other big financial institutions are in crisis. But government had no choice but to rescue them by providing enormous amount of funding to those institutions. This caused considerable problem because we are living in a free market economy, and one question that we politicians are asking to financial authorities is why those big institutions are special. If small banks failed, that failure, there is no government support. But if big one failed, government rescued with huge amount of money. This is distortion of economy, and it's also distortion of free market. So government clearly mentioned that we have to do something. And try to understand what this G-SIFI means with some analogy. I don't know it's really good analogy, but this globally systemically important institution is like a nuclear plant. It's a huge political issue in Japan and around the world. Nuclear plant is very important facilities to provide electricity, so it's a very important role playing in our society or our economy. Globally systemically financial institutions are the same. They are critical role to serve globalized economy. But as nuclear plant broke out, it's a huge mess, huge negative impact on the society. And this SIFIs, so-called systemically important financial institution, is similar. If that institution fails, that's a huge mess on the economy. So therefore, we have to do something. And this globally systemically important institutions issue cannot be resolved by single government. Because those institutions are globally active, so internationally, regulators, financial authorities have to collaborate and find a solution. Therefore, G20 leaders is playing an important role to find a solution with the other international regulators around the world. So let's move to policy response. So I hope that you understand why it's important and what the G-SIFIs is. And now let's move to policy response. So question here is how we can find a solution, particularly policy solutions to this challenge, existence of globally systemically important financial institutions. Naturally, G20 leaders declared the need for addressing this G-SIFIs challenge in April 2009, so a few months after Lehman crisis. And of course, G20 leaders by themselves cannot find to deal or detail technical issues, so they mandated the so-called Financial Stability Board. This board is composed of leaders of financial authorities, central banks, Ministry of Finance, or international organizations, like our organization or other international organizations. And as I'm a member of this FSB, I can provide you direct input or direct resolution from the very first-hand information. And this FSB published recommendation to the G20 how we should address this too big to fail or G-SIFIs issue, November 2010. So let's see what this G20 FSB's recommendations. This part is the most important part of my presentation. First, there are 3 policy measures to address these globally systemically important institutions, SIFIs. First, effective resolution regimes. What does it mean? Resolution regimes means that if companies fail, there is a mechanism to resolve this company, and this mechanism have to make it in an orderly manner. So if those big institutions fail, there is no negative impact on the economy. So there is no disorder to the economy. So if we can find a way that company can fail, company can die without any problem to the economy, that would help this problem. it is often the case that this failure will link with not only single government decision, but have to be coordinated with other government decisions. So coordination is critically important. So this is the first policy measures, resolution issue. Second issue is so-called higher loss absorbency. This means that capital means that to buffer. So capital is a so-called own fund of banks or financial institutions. So if they have additional capital, additional buffer, that would reduce the probability of failure. So second important policy measures that we advocate is this higher loss absorbency capacity, means additional capital or capital add-on, we call it. And third, we call it more intensive supervisory oversight. Naturally, supervisors, in case of Japan, FSA Japan Financial Services Agency or Kinyucho, is responsible to monitor and supervise those institutions. But in addition to the normal supervisory oversight, for this type of institutions, we need additional, more intensive supervisory oversight is needed. And these very high-level policy framework were declared by FSB, and the FSB and the national authorities, in collaboration with the standard setters like our organization, International Association of Insurance Supervisors, in the area of insurance, and Basel Committee in the banking, develop more concrete policy measures, as well as potential list of companies who should be regarded as systemically important. So now I just move to more specific sectorial approach, first banking, and second insurance, and then other areas. So banking. So first question is how we can select those systemically important financial institutions. Lehman was one example, but how many others exist? This is the mandate that the Basel Committee are requested to find. It's not easy, but anyway, conclusion was already published in November last year, and there are 5 categories to choose or to select those financial institutions. First category is size. In other words, the bigger it is, the more systemically relevant those banks is. So this is a very important category to identify systemically relevant financial institution in case of banks. And second, interconnectedness. So if a bank failed and this is interconnected with other banks or other financial institutions, that would naturally have bigger impact. I often use analogy of a tree or forest. If a tree have a fire because of thunderstorm or whatever and burned out, that is an event or just incident or accident. But this fire of a tree spilled over to other trees and all along the forest. That's a big issue. So this is a sort of spillover from one fire on one tree to spill over to whole forest. We call it interconnectedness because of interconnectedness. And this kind of scale of fire, we call it more sort of crisis. So this interconnectedness is extremely important categories or to identify systemic relevance of a financial institution. In other words, if a financial institution fails and all others are affected, so this is the one criteria that we want to identify. Subsidiarity, substitutability is if there is a substitute. Again, if a bank or failed, but immediately or other banks enter the market or existing banks take over the role of that bank, there is not so much impact on the system. But if a bank failed and there is no substitute, for a long period of time, there is again quite considerable negative impact on the economy. So substitutability is another important category to identify systemic relevance. Complexity is also linked with, to some extent, resolvability. If financial institution failed, but there is no way to resolve that company because company is so complex, and within the bank there's a lot of, for example, intra-bank transaction and so on, or a huge number of subsidiaries or branches, it's very difficult to resolve. So this kind of complexity is also important criteria to assess systemic relevance of financial institution. And naturally, we are discussing global systemic relevance, so this cross-border jurisdiction, in other words, global activities, is one important element that we should consider. And all these 5 categories that I mentioned here is equal weight. So in other words, there is a 100% score, and each category allocated 20%. So, and then we just collect data from banks, and then based on those data, we assess banks' systemic relevance from top to, in case of banking, we collect 70-some banks, so from top to 70-some rank in accordance with systemic relevance. And finally, 29 global SIFs. SIFs means global systemically important banks identified last year, November. And in case of Japan, there are 3 banks included in this list: Mizuho Bank, Tokyo Mitsubishi UFJ, and Mitsui Sumitomo are in the list. But naturally, there are plenty of other banks in the world who are in the list. So second question is, those 29 globally systemically relevant banks, what kind of policy measures, how we can address those problems? As I mentioned, 3 requirements. First, resolution regimes, enhanced resolution regimes. Second, higher loss absorbency, and intense supervision. By the way, those measures there are 2 objectives. There are 3 requirements, but 2 objectives. One is to reduce the probability of failure. In other words, if those banks do not fail, that's safer. Second, reduce the impact of failure. So even those banks fail, but impact on the economy is not significant, but also better. So reduce the probability and reduce the impact are important policy aims of those 3 requirements. So anyway, first let's talk about higher loss absorbency. Anyway, more simply put, this is additional capital requirement. And you might know that in the banking world, there is an internationally agreed capital requirements. In other words, around the world, all banks, particularly internationally active banks, have the same rules applied to the capital requirement. So simply put, additional capital requirement means that in case of those systemically relevant financial institutions, they have to put additional capital on the already required capital. So for example, if normal capital requirement is 100, they should put additional 10 or 20 or 30% more. So this is a requirement that the globally systemically relevant financial institution should comply with. Enhanced resolution regimes. That means that often it is called living will. Will means that, as you know, normal means of living will or will means that people before dying, they prepare agreement or just the future agreement, how their asset will be allocated to their family and so on. So this is the meaning of will. But this will is similar, but of course, it's a context of financial institutions. So financial institutions must prepare living will. That means that if, assuming that they are going to die or they are going to fail, how they allocate their assets and how make it resolve afterwards. So who will own the rest of the asset and so on. So this is also very important. As I said, if everything is clear and orderly die or resolve, they would avoid systemic impact on the economy, and they would very likely they would be able to be resolved without government support or government rescue package. So those are very important elements. So all financial institutions, 29 or globally systemically important institutions, now are drafting so-called living will. So they are working hard. By the end of this December, they should prepare this living will. And third, intensive supervision. So as I mentioned, it's every bank, every financial, so in principle, every financial institution should be regulated by regulator. But in case of these systemically relevant institutions, they need something in addition. More intensive supervision is needed. For example, you might know that companies are governed by so-called management and board of directors. And important role of management and board of directors, or Torishimari Yakukai, is to make a future strategy or what kind of direction the company would move. And also organize structure of the company. That's a very important role of the head of the financial institutions or any institutions. And in the past, and still, it's quite uncommon, it's not so common that regulators intervene companies' strategy or their structure. Because, as you can imagine, this is essentially companies' role to discuss and develop companies' future strategy or direction. But in case of this kind of companies, systemically important companies, we advocate that regulators should oversee, at least monitor companies' strategy or future structure. And in case company's strategy is very optimistic or extremely optimistic, it's a role of regulators to intervene and try to persuade companies to address this kind of strategy. This is a very new approach for regulators. Formally, regulators' role is to look at the past data or the current operation and try to correct companies' attitudes. But now, if we only look at the past or present, we cannot address the future. But always something happens in the future, so we regulators try to be more proactive and to see in the future, and therefore this kind of intensive supervision on the area of governance is very important issues. Let's see other areas. So this is in principle the banking side, and also in addition to this kind of intensive supervision of governance, there is also issue of selection of management. Who will be, for example, chief risk officer of the company? So it's a head of risk management of the company. Usually it's a board member. Formally, it's up to companies or financial institutions who will be head of the risk management. But now this type of companies, regulators monitor and just check if it is appropriate. and it's public information, so I could say that in case of Deutsche Bank last year, chief officer's candidate was not approved by financial authority in Germany. Deutsche Bank is one of the biggest banks in the world, and they have to select other person. So again, this is of course company's choice, but if they selected or candidate, they choose a candidate in a wrong sort of background or person, it's a role of regulators to intervene and to correct that action. So this is so-called intensive supervision, one of the examples of intensive supervision. So let's move to insurance. So insurance is one of the financial sector, but different from banks. So naturally, our approach, and I'm a head of insurance international organization. So this area is particularly I myself and my colleague developed in this area, and our selection category or this risk assessment category is similar to the bank but different, because our conviction is insurance systemic relevance is not coming from insurance industry as such. Core insurance business, such as, for example, automobile, fire insurance, or whatever, traditional insurance. But more like you might know that the AIG, American International Group, who are in crisis during 2008, and the U.S. government injected 180 billion, is the biggest rescue package in the history or anywhere in the history. So anyway, in case of AIG's problem was not came from insurance part of AIG, but it came from so-called financial product or department where they sell enormous amount of coverage CDS, derivative product. So our focus of insurance companies' systemic relevance is not core traditional insurance business, but more like we call it non-traditional or non-insurance business, such as credit derivative or other financial product or banking type of product. So we chose 5 criteria, which is similar, very similar to banking criteria, but the biggest difference is this non-traditional, non-insurance activities. We call it NTNI, is one of the most, or the most important category to select systemic relevance of insurance companies. And interconnectedness is again also very important criteria we regard. So otherwise it's the same as banking categories, but and also we put it NTNI much more weight than other categories. So NTNI and interconnectedness we put 70 to 90% of weight. So those 2 categories is dominant in assessment of systemic relevance. Naturally, size, substitutability, and international activities, we put some weight, but much smaller weight than NTNI and interconnectedness. And we are just developing a so-called list of possible companies who should be regarded, who will be regarded as systemically important financial institutions. And like banking case, banks do not like it, or to be nominated as systemically relevant financial institutions, because they're much more constrained, or they have to put additional capital, so create some constraint of capital allocation, and they have to follow much more strict regulation, and they have to prepare recovery and resolution plan. But I'm totally convinced that this is needed, or this is our role, regulators' role, that we have to impose on. As I said, if those companies failed, economy will be a completely mess, not only single country, but around the world. So we should do all possible feasible policy measures that we can take on. And therefore, we are convinced that those policy measures that I mentioned in the banking and insurance are more or less the same: higher capital requirement, resolution, enhanced resolution, and intensive supervision are must. They have to do it without any compromise and without any sort of discussion with the industry. So even they are very much against. In case of higher loss absorbency of insurance part, one difference between banking and insurance is insurance part, we still do not have internationally agreed capital requirements. So some insurance companies say that if we put something add-on based on national regime, that would create unlevel playing field. That means that the national capital requirement is different by country, and if we put some percentage add-on based on national requirement, the requirement is very different by country. To some extent, it's true, but on the other hand, as I said, buffer is helpful as to reduce the probability of failure. So I still think that that is needed, but we are now internally, insurance regulators, discussing how we can address this unlevel playing field. So anyway, we decided to put the capital add-on, but how we put capital add-on is still on the table. Enhanced resolution issue is very similar to the banking approach. So all the systemically important insurance companies have to prepare living will and make it ready to be resolvable. And intensive supervision, in case of insurance companies' operation, particularly internationally active insurance companies' operation, is still based on entity basis. So of course, each country has its own authority or responsibility to supervise each entity. But at the same time, internationally active group as totality, we have to monitor and oversee that company's operation. And we very much stress that those group-wide supervision, which is still in a developing stage of the insurance or supervision. So we very much stress that group-wide supervision is very important policy measures in the context of intensive supervision. So last part in my presentation is next steps. So now I described banking, insurance, current policy measures and development of policy measures. So what we should do in the next step. First, banking already announced which banks are list of G-SIFIs and what policy measures they should receive or they should comply with. But in case of insurance, we still have to discuss and decide policy measures as well as name of the systemic relevant companies. So that's a current status. And in addition, in case of banks, we have completed the work of so-called global SIFIs, but now they have discussed, or they are discussing domestic SIFIs, means that if that bank failed, that has a huge negative impact in a country basis. So let's say, for example, if a market share of a bank is more than 50% a single country, and if that bank failed, naturally that would be a huge impact on that country. So that is one example of domestic systemically financial institutions. So it's, of course, global systemically important institutions is naturally something in addition, but domestically systemically important institutions we have to identify, and also policy measures should be developed. And this discussion is just going on, and in November there is a G20 ministers meeting in 3rd and 4th November. So our report will be announced at that timing. So they more or less is finalized, but clear policy measures would be announced at that time. And the insurance current going on discussion will be concluded sometimes by this global SIFI discussion will be concluded early next year. And from that period, we are going to debate on domestic systemically relevant insurance companies. Other areas. Now I mentioned bank and insurance, but there are some other financial activities. Particularly, we focus so-called shadow banking. So shadow banking means it's like banks, but it's not under the banking regulation. One typical example is money market fund. The product is very similar to deposit. There is guarantee and people can withdraw quite easily, but they are not the same regulatory oversight. So those activities, we call it shadow banks, and we have to regulate in a correct manner. Otherwise, what would happen is financial institutions shift their activities from banks to shadow banking, and they have less regulation and they have more activities. So in total, as a system, the financial system is weaker. So in other words, there is a gap. There is a gap in the financial system, and we definitely have to address or avoid or fill in those gaps. So shadow banking, now we are developing policy measures. It does not necessarily limit to global systemically relevant shadow banking, but the general policy measures we are now developing. And again, this will be concluded in November G20 ministers meeting. And assessment in the context of systemic relevance or methodology will be developed next year. So, Professor, I just stop here. This time I don't spend so much time, and I hope you understand, or hopefully at least you get message of this activity. And again, we are doing our best effort, but as you can see, it takes long time because crisis was 2008, last crisis 2008, and we are still developing our policy measures now 2012, right? And we have not finalized this issue. But because of international coordination, it takes so much time. But at the same time, stake is high. If we make a mistake, it's a huge impact on the economy too. So we try to make a best policy, even though it takes a bit longer time. And particularly this G-SIFIs issue is very important for economy, not only single economy, but global economy. So we work hard and try to establish a right policy and implement correctly. So I stop here, and just appreciate your comments, questions.
Okay, first, thank you.